This is Declarations.
Families consistently invest in real estate. That is one of the things that I think is true for family offices across the board. They are still allocating capital to that space. They're still excited by that space.
Hi, this is Todd Rich, the co-founder of Declarations Partners. Welcome back to the Declarations podcast. The purpose of this podcast is to engage with thought leaders in investing who provide an independent perspective. Our goals are to explore the foundations behind their success, to understand the source of their inspiration, and through these conversations, to become better investors. We hope you enjoy today's episode. We are excited to welcome Sean Plummer today. Sean is the founder of Haystack Capital Partners. Haystack is dedicated to working with family offices, business owners, and entrepreneurs in a manner different from traditional placement agents. Prior to founding Haystack, Sean was responsible for the establishment and direction of the direct investment program for Fidelity Family Office Services. His work at Fidelity and now Haystack gives Sean a unique window into the specific investment preferences of family offices. In today's discussion, we will explore how Sean's background positioned him as a trusted advisor to some of the world's wealthiest families. We will also try to understand how family investors approach the world differently from their institutional counterparts. We'll delve into some of the specific characteristics that family offices look for in partners and investment managers. At Declaration, we are proud to have worked closely with Sean for over 3 years now. And I am proud to disclose that Sean is an investor with us at Declaration. We hope you enjoy learning from his insights. Sean, welcome to the podcast.
Thank you for having me, Todd. It's truly a pleasure to be here. And I'd also like to thank you for the partnership and friendship that we've had over the last 3 years. Working with you and the Declaration team is candidly what makes my job so enjoyable and so fun. So thank you for that.
No, look, that's mutual. We feel really proud of our association with you, and it's been a lot of fun personally. So, Sean, as we delve into it, as you know, we named our business after the Declaration of Independence, and we really view the Declaration as a foundational document, right? It lays out the aspirational nature of the American experiment. So let's start with you the same way we start with all guests. Sean, what is your declaration?
Yeah, mine, I think, is relatively simple, but my goal is to listen and learn from everyone that I interact with. I've had, and we'll get into it later, but I've had the opportunity to live in Central Valley, California, the Midwest, and ultimately New York City. And during that course of time, I've been around farmers and teachers and plant managers and CEOs and ultimately billionaires. I've found it's easy to listen to the luminaries of the world that have been incredibly successful, and you want to learn from their success. But I also have found it's equally as valuable to learn from the people who haven't had those opportunities, that are really doing the heavy lifting in our country and in our society. And I found by better understanding their situation, it's enabled me to have a better perspective of life. And so that's my declaration.
I love that. Let's talk about the perspective on life. You mentioned the Central Valley of California. You grew up in Davis, California. So what is your life perspective? How is it shaped by growing up in the Central Valley?
Well, on an incredibly biased opinion, I grew up in the greatest small town in America, hands down. Davis, if you haven't been,
we all think that about the small towns where we grew up.
It's very, very true. I think we also have a similar opinion in some of the larger towns as well. So Davis is in the Central Valley. It's about 30 minutes or so outside of Sacramento, a large agricultural hub. So a lot of rice farming, tomato farming, cantaloupes. And then it ultimately became the agricultural college for UC Berkeley. So that's where UC Davis was established. And it was a great place to grow up. You had this interesting mix of migrant workers and farmers and multi-generational landowners, and then all the administration associated with the university, as well as international PhDs that were working there. So in this small community, you had all these different walks of life. It didn't feel like there was a real focus on wealth or display of wealth. So everyone was kind of at a level playing field from how they interacted with each other.
It's so interesting to hear you say that, because that sounds very appealing to you. And yet you, and we'll talk about this later, but now you actually work in a world that is really inhabited by people with extreme wealth. And so it's interesting to see that what appealed to you was actually the mix.
True. Well, I think a large part of what appeals to me is a a general decency. I think if you've had the opportunity to interact with a lot of clients that we interact with, I know you've had podcasts with some of them as well. They're all decent people. They've been obviously wildly successful, but they have a sense of ethics and a sense of responsibility that I think happens in all walks of life.
I agree. I sometimes joke, billionaires are people too, and but it's true. The people that are most enjoyable to work with are in fact the people who have good values, who are humble, who are kind, and I think that general decency can come in many forms and at any income or wealth level.
We work with a lot of first generation families. Many of them were entrepreneurs. They started with a pretty humble upbringing, and most of them have not lost sight of that. And I would also say that if you're going to have real staying power in any business and you're going to have real partnerships that allow you to grow, you better have a real sense of decency and honesty associated with it. You're not gonna make it.
Yeah, look, I totally agree. So you grew up in Central Valley. You talked about the appeal of living in this place that had a mix of farming and landowners and a university, the ag school, I guess you said. And yet you chose not to go there for school. You chose to move to the Midwest, to Ohio Wesleyan University. So how did you adjust from being in a small town outside of Sacramento to, I guess, a somewhat smaller town, but in the Midwest?
Well, I would tell you, I was probably the first of a trend of one to leave California to go to Ohio. I really wanted my own experience. I wanted to get out of California. I wanted to have something that was mine, I was making new friends, making new relationships, beginning to establish what I wanted to be. I think also importantly, my father's from Little Rock, Arkansas, and my mother's from Grand Rapids, Michigan. So there's a real sense of kinship to the Midwest when I was growing up. It was very interesting because Delaware is a small town north of Columbus. Delaware, Ohio, excuse me. So not dissimilar from Davis. But the school was, and this is in 1993, the school was 50% Midwest based, about a third East Coast. There were four. There were four. Not from Davis, but California, the whole state. And so I ended up joining a fraternity there, and my fraternity was 100% East Coast. And so it was hugely eye-opening to begin to interact with people who were from New York City, Connecticut, had very strong opinions about pizza.
Well, and it sounds like you were influenced somewhat by the East Coasters because you decided that after college, you wanted to go into investment banking. And I'll admit to a bias, which is that I don't often think of Delaware, Ohio being the capital of investment banking. And yet you somehow did it. So how did you get into investment banking?
Yeah. So my original major was politics and government. I thought that's what a career I wanted to pursue. I did an internship in DC for the National Restaurant Association and realized pretty quickly that was not how I wanted to spend my time in politics and government. So I went back to school, changed my major to economics and accounting, and really enjoyed that education. One of the things that happened in my economics class is our professor would have a bunch of the business leaders in the Columbus area come in to lecture us about their very various businesses. As you can assume, a lot of those businesses were relatively simple, family-owned tool and die companies, steel press companies, et cetera. But Columbus also has a very large industry around Wendy's, The Limited, et cetera. So it was great to learn from those executives about how did their company get started? How do they handle risk? How do they look at the growth of their businesses? And I was captivated by that kind of origin story of these operating companies. Less so on the capital market side of things. I didn't enjoy the public market stuff, but really like the operating company. I also learned that I wanted to be successful. I didn't know what that really meant, but I knew that I wanted to provide an industry that allowed for that. And so I read an article, probably my end of my junior year, maybe early part of my senior year in Newsweek, that said investment bankers were the highest compensated people on the street. And so I didn't know what investment banking was, but it seemed like that was potentially a good thing to do. And so I got a job at the alumni relations office and quickly went through their database, finding every single investment banker in Columbus. And to your point, there are not a lot, but I wrote letters to all of them saying I'd work for them for free. And all I wanted was experience. not too dissimilar from an internship that you would normally have, but I didn't have that opportunity. So I wrote 12, 13 letters. And to my surprise, almost everyone said no. But there were two guys, Tim Long and Michael DePerna, who were at Miller and Schroeder, which was a public finance shop based out of Minnesota, but they had a branch in Columbus. And they gave me a shot. And so my second semester senior year, I started working for them part-time while finishing school. And to my pure luck, Tim Long had made a determination that he didn't trust anyone who worked for free. So got paid, I have no idea, $5 an hour, whatever the number was, more money than I had had before. And that started my investment banking career.
And you lasted in investment banking just long enough to decide that it wasn't actually what you wanted out of life. What was your path from investment banking? Ultimately, you went to Fidelity Family Office Services. How did you make that transition and why?
Yeah, so it was a couple of things. One, so Tim and Michael had created these bond funds in the state of Ohio, one for Cleveland, Cuyahoga County Port Authority, Toledo, Lucas County Port Authority, and the state of Ohio. And effectively, these funds were rated by Fitch and S&P, and they were able to provide investment grade paper to non-investment grade companies throughout the state, really with a goal of economic development. So these programs, while I was there, I think created a little north of 3,500 jobs, which is pretty cool in and of itself. And I want to be very clear. I was an analyst. I was running, at that point in time, Lotus 123, and was a glorified chauffeur for my managing directors. But they were true to their word. They gave me a lot of experience. And I think also because we were a small team, they let me interact with the executives and CEOs of these various companies. So I got a further insight as to how these family owned and operated businesses ran. What was the generational transfer? How did they look at risk? How did they look at growth? And that was fascinating. And it's kind of funny looking back. Those are effectively the families that I deal with now on the family office side. And so from there, moved out to New York. We had then been acquired. So I went from Miller and Schroeder. We then left to go to McDonald and Company. McDonald and Company was acquired by KeyCorp. This is in the late 90s with the repeal of Glass-Steagall. And KeyCorp started a technology, media, and telecom business in New York. And I threw my hat in the ring, was able to get that job. So that's what got me to New York. I, as you mentioned, got a little disillusioned with investment banking, got tired of telling people how smart we were. I wanted to actually build something or be associated with something that built something. So went over to a company called Advent Software for a number of years. And then that management team left, or a portion of that management team left to go over to Fidelity on the family office side. And then I was recruited over there to Fidelity Family Office Services or FOSS.
And what was your role there at FOSS, Fidelity? What did you, maybe a little bit, I think, working for Family Office Services, presumably you were working with wealthy families who entrusted Fidelity for some portion of their wealth. What did you learn about working with families at that time?
So Fidelity at that point in time, I think it's probably true, and a lot of people aren't aware of this, that they probably have one of the largest client base of single family offices in the country, predominantly around custody and clearing, and they're a wonderful counterparty risk for these families. But they basically had a custody and clearing business, and then we're looking to monetize that through effectively a prime brokerage model. So trading, margin, stock short, et cetera. And that wasn't really a great fit for the way that most families conduct themselves and how they invest. And so we were looking at ways to increase our relationship with these clients.
Okay. And what were those families looking for?
Yeah. So keep in mind, this is 15-ish years ago. The traditional model was, and I'm generalizing, but a family would sell their business, have their liquidity event, allocate a portion of their capital to Goldman Sachs, Morgan Stanley, their local wealth manager. They invest in the blue chip private equity firms, the Carlyles and the KKRs of the world, and their controller would come in and kind of manage the family office. When I joined Fidelity Family Office Services, my first job was really flying around the country, meeting with his CEOs and CIOs of family offices, saying, "What do you want? And if we build it, what would that relationship look like?" And it became pretty clear these families were, generally speaking, younger than historically. They were more entrepreneurial. They maybe had a liquidity event, but wanted to continue to grow with their wealth. And I think they were waking up to the idea that they could do some things that other institutional investors couldn't really do. And they wanted to have more influence of their wealth, more influence of what their investments were, and started looking at doing direct investing alongside like-minded family offices. in lieu of traditional private equity exposure.
You were trying to solve the problem that family offices had, which, if I heard you correctly, was family offices wanted to invest together with one another in differentiated private investments, but they wanted to do it somehow distinct or in a different manner from the large institutional investors.
Yeah, I think that's fair. Yeah, where they would say, listen, I have a lot of operating expertise. I have a strong management team. Perhaps we can go find deals that we can lead in our wealth creation space. And alternatively, perhaps we can get partnered up with other groups that are equally as capable in a different vertical. And so we at Fidelity created more or less a cap intro function where, because we were in the relationships with all these various families, where we connect families that were doing deals and looking for areas where other families looking to deploy capital. And so that was one of the kind of core missions of my time at Fidelity.
And I guess it was that experience that somehow led you to believe that there's a different way for you to do that personally as an entrepreneur outside of Fidelity. Is that ultimately what led you to create Haystack?
Yeah. So that's completely correct. So there was I learned this when I was at Advent, that if you ask clients what they want, you build what they want, and that's a tendency to be a decent business. And so we were hearing very clearly from clients that, hey, I want exposure to more family office-led deal flow in my wealth creation space or outside my wealth creation space. So that was part of the solution. And then the other part that had happened was we were dealing with the operating family saying, I want to grow my business. I want to go acquire another business. I want to get back into my industry or buy my firm back from private equity, whatever it ends up being. But they were getting disillusioned with viewing traditional institutional capital as their sole outlet. They were getting tired of getting chiseled with fees, potentially not getting return phone calls even after they made a fair amount of money for that firm. And also, and I think you found this, a real misalignment with the operator and the ultimate capital partner, having to sell assets sooner than they wanted to and not really having the ability to build things for the long term. So we had a decent marketplace there. And I looked at the fact that I had a pretty strong relationship amongst a decent base of family offices and felt that we could build something that was a bit differentiated for those families.
And I presume the name Haystack has something to do with that finding a deal is like finding a needle in a haystack, or is it finding a family is like finding what's the evolution?
Oh, well, the evolution was, and I'll use proper language for the podcast, but there's a lot of crummy deals out there. And if finding a really good one is finding a needle in a haystack. And when Haystack started, we were solely on the direct investment side. And so we were looking at deals where we could bring in additional families to invest. And
by direct investment, what you mean, I think, is individual company opportunities. So is that right? As opposed to working with funds or some sort of club deals or things like that. Is that right?
That's correct. Yeah, that's absolutely correct. And so we would look for scenarios where we could bring capital in, but also where the families that we brought in added a level of operational expertise. And so we felt that was the needle in the haystack.
And how has it evolved since you started?
So the business started initially solely on the single asset side and felt that blind pools, in large part of reaction for what our clients were looking for, were not where we were going to begin to differentiate. As the business has evolved, and it's been around now for 11 years, we're somewhat of a split between direct investments and fund investments. And maybe if it's helpful, I can take a step back and kind of give a primer of what Haystack is today. So we serve as a placement agent really for about 160 families throughout the U.S. They range in size from, call it 200 million up to 30, 40 billion. The commonality of those families is really twofold. One, they're very institutional nature. So they've got teams of people like you and your colleagues that are investing their capital, allocating their capital, running their assets. And two, and I think potentially more importantly, about 80% of our clients are first generation wealth. So very strong operators in everything from healthcare to real estate to technology, et cetera. And so we spend about half of our time working on deals being led by those families in their wealth creation space, where they're going to go and they're going to buy some Class A assets at distressed pricing. Perhaps it's some growth equity, whatever it ends up being. We're looking for deals that they're leading in the area which created all their success. And they've determined they want other partners to invest alongside of them, but they've determined that they only want other family offices as their partners. And so that's half the business. And then the other half of the business is we found over time that families do want exposure to funds and alternatives. And we also found that our families were really, really capable management teams to go run a fund, no different than a declaration. And we want exposure to that, and the thought that our families would want exposure to that. But there too, we're looking for funds that are more niche oriented, that are completely family office focused. And if they've determined they only want families as an LP or a limited partner, they're not looking for any dollar to be a good dollar. If that makes sense.
And so, it sounds like really core to your business is this concept that family offices tend to think differently from institutional investors, and they seek to carve a different or distinct, unique path that is more aligned with other family offices. So why is that? What are the differences that you've noticed, or what are the themes that people talk about that would lead them to believe that investing with other families is somehow distinct or better than investing with institutions?
If you look at family offices, the one thing that they have that many people don't have is complete freedom. They can go into any asset class at any point in time. They can be contrarian, but also use common sense. A good example of that is, we saw the transition into ESG however many years ago. At that point in time, anyone who was in the E&P side was going to have a hard time raising capital. Everything's going to go
meaning
electric.
exploration, production of oil and gas assets. Is that what you're talking?
Correct. Yeah. Excuse me. And everything's going to be like electric, and they're going to be battery powered, and that's where everything's going to go, and that's where all the institutional capital is going to go. Families on the other side, especially if they were an energy family, said, well, wait a minute, I'm making a fair amount of money in the oil and gas business. People are still driving cars. People are still flying planes. I'm going to continue to invest in that space, but I'm also cognizant of the fact, based on decline curves, that there will be a transition at some point in time. So let me focus on the today, and let me build for the future over the next 10, 15, 20 years. And so I think that common sense approach can really enable families to be much more thoughtful, can allow them to find opportunities in the marketplace where institutional capital won't go, even potentially if they should. And so we feel that's helpful. And I think the other side is, when your investor base is, broadly speaking, 100% taxable, you have a much different approach than having a blend of taxable and tax-exempt investors.
Yeah, that makes sense. I guess in particular, if you're looking for longer-term compounding, right? That adds up over time. But it's funny because on the one hand, what you just described were sort of common themes that might happen within the family office space more broadly. But as you know, there's a joke in the family office sector, right? That if you've met one family office, well, then you've met one family office, right? And the implication, of course, is that every group is different, and that there are very few families that would think alike to a different family, right? That they're all unique, their own sort of snowflakes. Is that true, or are there common themes that people are looking for when they invest?
There is definitely I think a truth to that. And listen, they're all incredibly wealthy. They've all at some point in time been quite successful. From an asset allocation, they broadly have more exposure to alternatives than other people. They have a longer term horizon. But if you drill a layer deeper, you definitely see there's a bunch of different forks in the road. Do they have their operating company? Have they had all their liquidity? That really informs how the family office behaves. Are they first generation? Are they multi-generation? How many mouths do they need to feed? Are they focused more on the public side? Are they focused more on the private side? And then I also think that sizing has a real impact on how families operate. Are they sub 1 billion? Are they 2 billion to 5 billion, 5 billion to 10 billion, and 10 billion above? And those various assets under management, I think, have a fair amount of impact as to how large their teams are, potentially how deep in the weeds they want to go from an investment standpoint.
Hi, this is Todd Rich. Thank you for listening to the Declarations Podcast, where top investors and business leaders share their insights and provide an independent perspective. We hope you're enjoying this episode. If you'd like to learn more about Declaration Partners or listen to more episodes of the Declarations Podcast, please visit our website at www.declarationpartners.com. And now back to the episode.
Let's talk about some of those. I mean, you mentioned several categories that lead to generalizations. Just pick one of those categories, whether it's the size, whether it's, East Coast versus West Coast, or families who have an operating business versus not. What are some of the generalizations that you think you would make about families in a category, one category versus another?
So I think the operating company versus the investment management side. So operating company, the family still has their legacy business, or I'll say the investment management side, which is they've had their liquidity event, and now they have a staff that is focused on solely investing that capital, no different than an asset management firm, but just on behalf of the family office. And so the operating families, they have this cash flowing engine associated with it that has been around for decades or potentially generations. The family has a deep familiarity with it. They may love it or they may hate it. That kind of depends.
Does it depend on how much cash it's distributing out for other things?
Yeah, potentially. They know all the risk. They've been around it so long, they may not even perceive that risk to be real risk. They know the counterparts. They know the cyclicality. And so that really informs a type of behavior. And I think it's interesting. A lot of those families who have these meaningful operating companies say, well, we want to begin to diversify away from our operating business and have more exposure to other industries. So, I feel sorry for a lot of the CIOs that have that job, because when a dollar comes in, what am I going to do? I can give it to the thing that I know very, very well. So I can take that dollar and get a 30% return and pay no fees and have total control. Or I can go allocate it to another fund or co-investment or single asset investment where I'm probably going to pay lower fees. I may not have total control. And on a really great return, maybe I'm going to get a net, high teen, low 20. And so that really, I think, shapes how these families are looking to allocate that capital. And you
really do have to dig deep through that haystack, I guess, to make a pitch.
Yeah. And then you contrast it with the asset management side, where listen, they're looking to allocate capital. They're building a deeper Rolodex of funds and relationships to go be stewards of that capital.
Got it. That's interesting. And let's go to that group then. That group, you said, looking for specific characteristics when they choose to allocate capital. What are they looking for? What are the things that families seek when they're making a private investment, or they're selecting an investment manager, a fund manager? What are some of the characteristics that they would look for?
I want to be clear. I only want to speak for my sample set, because there are so many families out there, both in the U.S. and internationally, that may have a different perspective.
Got it. So you only work with 160 of them, and there are more out there. I guess there are several.
There are so many more that it boggles my mind. I've been in this space for close to 2 decades. I'm amazed with how many families I don't know. But listen, I think at baseline, when they're looking at transactions or funds, they're looking for strong fundamentals, capable management teams, people with real experience, the same thing that everybody else looks for. But I think prior to that, they're really focused on relationships. What is the depth of relationship that they can have with these operators and fund managers? They want to be with people they like and trust, because generally speaking, they're looking at this for a multiple fund or a multiple decade relationship. And so I think that's incredibly important. They're also looking for, and these are the things that we look for as well at Haystack, is a high level of alignment. They want people that have real skin in the game. I don't think it's as important what the notional amount is, but from a percentage of net worth for the managers and for the operators. They want to know that they're not dipping their toe in the water, so to speak, that this isn't a free call option. They can go back to their day job, that this is what they are doing regardless of the outcome. I'll give an example of that. We work with a mineral rights manager who's been wildly successful in what they're doing. But one of my clients who's invested said, listen, I candidly don't care if they come back to me with a 1% return, because I know that they've done everything humanly possible to generate that 1%. And we'll still allocate to them because we know them, we like them, we know that they are fighting on behalf of our family for those returns. And I think that's the relationship that families, the depth of relationship, I think, is important. And then I think if you go more on the transactional side, if that's helpful to share, where families, I think, are oftentimes looking for smaller sized managers and deals. Generally speaking, areas where institutional capital is not going to play, where it's not as competitive.
Why smaller? Is that just an acknowledgement that perhaps the larger funds or fund managers are really at some point you get big enough that effectively all you do is invest in beta, or is it because they want to have a more deep relationship, as you just said, and therefore, if it's a smaller manager, perhaps the family capital can become a more significant portion? What's driving that comment?
I think it's both. I think it's one, even a very, very large family is not going to write a check in the size of a blue chip private equity firm, right? Where they're deploying billions of dollars. I think it's also to make sure that they have alignment with, that they're a meaningful LP, that they have access to the manager, they can participate in co-investments, they have the opportunity to really learn from the funds and the operators that they partner with. So I think they want that type of exposure. I also feel that, and we like this space a lot, if I can operate subscale, I'm not going to compete with capital that has to be deployed. I can begin to build relationships with mom and pop operators, things of that nature. So maybe I can get things at a lesser, more attractive price. I don't have to participate in auctions. And then as I grow that business, I have a natural sales process to private equity who's looking for these larger so I think they can be beneficiaries of both sides of that.
Now, maybe moving beyond the characteristics of the manager or of the relationship, what are some investment themes that families are looking for right now? What are you hearing from your clients that in the current environment, what excites them?
I think you can definitely get into the micro, but you almost have to look at the macro in where we are today. Illiquidity is a huge challenge right now in the market. Private equity has not been distributing much in the way of returns to their investors. And so I think families that have these cash flow and operating companies, that's fine, where they have liquidity and they can continue to invest. But the more asset management driven families are struggling to look for new investments and manage re-ups with existing managers they have. So if 2 years ago they were making 5 bets on new managers or new individual transactions, maybe this year they're only looking at 1. So they're much more selective. I think that is a challenge. I think they're viewing blind pool risk similar to investment risk, that if I'm going to make my 1 bet and I don't know how quickly you're going to deploy that capital, I've effectively missed out on other opportunities that I could have made with that singular bet.
The irony, of course, just hearing you is that it feels to me that if everyone is thinking the same way, right? Everyone says, wow, I went into some illiquid private investments several years ago. I picked a lot of new managers. Now, oops, I haven't received a ton of liquidity. And so I'm not going to invest again, or I'll be much more selective, I guess is the way you're saying it. And I'm only going to focus on re-ups with those same people who I guess haven't really generated the distributions yet. It creates this weird world where, am I right to think that maybe that means that those who do choose to lean in now might actually have a less competitive playing field? They might actually be able to get better deals, or am I thinking about it wrong?
No, I think you're thinking about it entirely correctly. It's in the benefit of the limited partners out there, but you're seeing a dramatically extended fundraising process. And so by the time you're getting to final close, you're seeing a lot of funds that are 20, 30, 40% invested by the time they ultimately finish their capital raise. And so that's a great opportunity for LPs to take a pretty good look at the portfolio, potentially have some form of multiple already been established, potentially on paper, but at least you get a better sense of what you're investing in. And it provides opportunities for LPs to get into transactions maybe they wouldn't have access to beforehand. So I think it can be beneficial for the families.
Yeah, but I was saying something different, though, which is, I think you're saying that the portfolios that are being managed might become attractive by the time a final closing might happen. But you've also said that families might be pulling back. They might not be investing. I'm actually a little surprised, only because when I think of some of the strengths of family office capital, I think of a universe of people who has not been constrained by the prototypical herd mentality of institutional capital, and that when institutional capital pulls back, because I imagine they're having the same distribution slowness. And I would have thought that family office capital would see an opportunity like now to do the opposite, which is to lean in more. But are you not seeing that?
No, yeah. So let me. I think both are true. And now we get back into every family is different, but if I don't have liquidity, it's very hard for me to invest. That's a very understandable.
That's usually the rule, right?
Yeah. So I think that's part of it. But then the families who do have some form of liquidity, this is a great opportunity for them to continue to deploy capital where there's less competition. So I agree with both statements.
Fair point. Well, so now themes. So big theme, fundraising, I guess, is hard, takes a long time, and people are waiting for liquidity. But for those families who have liquidity, what excites them? What are they trying to invest in?
Yeah. So we've seen a lot of movement into private credit over the last couple of years. I think that space is getting pretty crowded. It feels like everyone and their brother has a private credit strategy. We're seeing families still spend a fair amount of time looking at secondaries and view that as a real opportunity for them.
I guess actually that's a play on lack of liquidity, isn't it? It's other people haven't had distributions. Managers might be creating distributions, or LPs might be trying to sell. So is that the theme?
Yeah, totally. It provides a great opportunity to step in. The people who are, I'd say, earlier on the risk curve, or a little bit further out there, looking at AI. How do I play AI? Am I going to do it by a bunch of seed investments into smaller funds, hoping that maybe there's one or two companies in there that are real winners? Or do I play it through more seasoned venture capital allocations, or potentially on the public market side? Then I'd say there's also a constituency that says maybe this is a bubble and maybe I want to hold off and see how AI evolves. We are looking at much more into healthcare and health tech. I think that's an area of growth and opportunity. And then we're looking at defense tech and infrastructure, although on the infrastructure side, I'm not sure how well that will marry with our goal to invest in smaller managers, because it just requires so much capital. Families consistently invest in real estate. That is one of the things that I think is true for family offices across the board. They are still allocating capital to that space. They're still excited by that space.
Yeah, that's music to our ears, as you know.
Yeah, absolutely. We're seeing families spend more time in real estate, trying to take advantage of the rising interest rate environment. People who may be a little over their skis, it could create some, I think, as you know, some very interesting special situations in the real estate market. Well, I think you've done a very good job of determining what those opportunity sets are and sourcing really differentiated opportunities.
One of the things you said about families, which is that they select investment managers or partners based largely on the relationship that they've built and on the trust that they've been able to engender with that manager. Actually, that's true in your case as well. It seems that in many ways, your success is highly dependent on the trusted relationships that you've been able to build with these 160 families. So what is most important? What have you done to cultivate these relationships, to maintain them? What advice would you give someone else trying to do so?
I think to have a real relationship with a family office, it needs to be more than just a transactional experience. I think it needs to be a real relationship with them where you're adding value and they are as well. When I learned this at Fidelity, I was still surprised by it. But if you look at a family office, when they get together for their quarterly meetings, their annual meetings, they're spending 3 to 7% of their time talking about their investment portfolio. And everything else, no different than probably your family and your spouse and me and my family and my spouse. There's so many other things that are associated with that family. I also am cognizant, and this isn't true for all families, but many of the relationships they have, you're an extension of that family. You are. I mean, we see this in our relationship with Declaration, our family's relationship with Declaration. They're looking to you to provide and educate them as to what's going on in the real estate marketplace. Where is the opportunity set? What are you seeing? What are the trends you're seeing? And I think that transparency and that level of communication is incredibly helpful. And I can't compliment you enough of what a good job you guys have done in doing that. And I think it really ingrains you with the family offices.
Well, it's nice of you to say, but I actually think that the reverse is true, which is to say the beginning of your statement that you believe that relationships are really two-way in the family office space. It's not transactional. It's about building a fostering relationship where you can learn from one another. I actually think we have benefited greatly from our own family investor base, where we're able to learn from them. We're able to ask questions of them. So it's kind of you to say, but I actually think it goes the other way around, where we've really benefited.
That is true, because if you look at a standard LP, and this is my own personal opinion, obviously, but if you look at a standard LP, that's great that they can invest. But if you look at some of the people who on the family office side that can potentially invest, look at the level of expertise they have and the experience that they've had. And as I said before, they're all generally speaking entrepreneurs. They want you to succeed. They want to be part of that growth that you experience. And they're a wonderful group of advisors.
I totally agree. I mean, to me, the real question is how, over the next 5, 10, 15 years, how to cultivate that group of unique individual family office investors into a network that is aligned with one another to help one another on a more regular or more systematic basis, because I think the power of that could really be unstoppable as an investment force.
Yeah, I have a shared experience within that ecosystem. I think that's what can be harnessed when you bring in the right partners, both on the family office side as well as on the investment side.
So let's get to that then. How does one identify the right partner? You can't create that sort of bond with everybody, right? You're trying to marry an investment opportunity with someone who is seeking an investment opportunity. And you're trying to do that by ensuring that there's an alignment of shared values, of shared vision, that there's this bond that can be created. And so how do you recognize when one is possible?
It requires a high level of EQ. And I don't think a lot of people have that in the finance world. We look for people that obviously have an incredible track record, incredible level of success, are very good investors, very good operators. But then they also have to have the ability to be able to potentially vulnerable to begin to build a relationship and to look at things beyond just their current need. So if you're looking to raise capital and you say, I get it. Let's say it's a first-time fund, which we spend time on. It's how we got to know you guys. I'm going to raise a first-time vehicle. I'm only focused on raising capital for that vehicle. That's not that interesting. It's not helpful for you. It's not necessarily helpful for us. But if you take a more holistic approach and say, listen, I don't care if you come in for $1 in the first fund. I want you to begin to build a relationship as you get to know us. And then we can have a true partnership over time, because it doesn't happen in the course of 2 meetings. And so we spend a lot of time looking at that.
I'd argue that this cycle isn't 2 or 3 or 5 or 10 meetings. It's sometimes 2 to 5 years. But I think that does allow you to actually evaluate the relationship, forge a relationship, build upon it. I think it does create a real depth.
Yeah, you're absolutely right. We are in the investment management space, right? That's our job. That's your job. But we're really in the customer service business. We're building these relationships. And it's no different than a restaurant or some consumer business. And I think that's very relevant.
Look, I totally agree, but I will say you could have a great host or hostess, a fantastic waiter, but if the food isn't good, you're not coming back. And I think it's actually the same thing. I think that those of us in the investment management business need to first deliver the product, right? Which is to say attractive risk-adjusted returns. But I think that when delivering the product, we should provide a wrapper of actually providing service to the customer, to the client, to really build that relationship. I think that you have to do both things. I think
absolutely. No, listen, if you don't generate returns, there's not much of a conversation to be had.
Yeah,
and the other side is true. I mean, if you do a good job of harnessing these relationships with families, they're going to be with you forever. Many of these families take a bet, say, you are going to be my real estate exposure, you're going to be my multifamily exposure, whatever it ends up being. They, broadly speaking, have more capital than they have employees. So they want to keep that relationship. And I think also done correctly, and you've experienced as well, these families, when done correctly, can be a great sourcing advantage for the managers. I think it enables you to have a different story and to differentiate your process when you're out in the marketplace.
Let's talk a little bit about the future. So you've been now in the family office investment space for a little over 15 years. It's longer than some people even knew what the word family office meant. And what trends do you recognize sort of more broadly in the space over the next 5, 10, or next 15 years?
if you go back to some of the earlier comments I made, we saw an expansion of what I call direct investing or single asset investing amongst families. And I think there's a couple components there. One, for some families, that's their DNA. They want to do direct deals. They want to build companies. I think another segment of families said, listen, we want to go build a team to go do direct transactions. We want to do it internally. But we're really doing it as a way to create alpha. And I think a lot of those families are looking back 5-10 years later and saying, this is really hard. We've had to build a meaningful team. We've had to compensate that team. We've had a lot of fees and consultancy fees, QOVs, dead deal costs, et cetera. And we also had to compete with traditional private equity for these assets. And so maybe we didn't win as many deals. And I don't know if I want to continue to do that. We're seeing more families take a step away from pure direct investing internally. We've seen it on the smaller scale family offices, as well as the larger scale family offices that could have those resources available to them if they wanted to. But just said, listen, let's go find someone who invests like we do. And we can also have a little bit more influence of where our capital goes through co-investments. And that may be a better outcome for us. So that's part one. Part two, and I don't know how, it's interesting. I think they happened independently. We've seen more family offices say, well, let's look at this maybe differently. We're going to invest all of our capital. We're going to go do that, but we're going to raise outside funds as a way to generate carry, as a way to compensate top caliber talent. And we're going to go invest those funds exactly like a family office does. And so I've got the best team. I've got an ability to source. I've got subject matter expertise. And then I can go find individual transactions, be it on the real estate side or the real asset side or the operating company side. And I'm going to be flexible about my hold period. I'm going to be thoughtful about how I want to structure things. And I'm going to also make sure that almost 100% of my LPs are family offices. So we look and feel like a family office, like a declaration. That is a trend that's going to continue to have success in the landscape. I think you guys are in a great seat to do that, both on the real estate side as well as some of the other ventures that you're pursuing.
Well, I mean, those two trends are really complementary, actually, if you believe it. If you believe that both are true, right? That the one trend is that certain families who have historically preferred direct assets might instead prefer to go into a fund or club construct. And you separately believe that certain established family offices will try and create teams that can marry the sophistication of sort of traditional private equity with a family office mindset. Like those two likely merge, right? That becomes an avenue for those families who are seeking, to invest like a family, to come together, some to allocate and some to sort of grow it. But it seems like they merge. So you mentioned earlier that many of the families that you work with happen to be first generation. That can't last forever because, generations sort of pass, right? And so it implies that there is, over the next X number of years, where X may not be a very big number, there will be a transition largely to second generation family offices, unless everyone's giving all the money away. Some are, obviously, but many, I suspect, are trying to continue their family legacy. Many of the second generation are seeking to sort of, take over the reins. What are the implications of that? Have you started to see any trends that have emerged specifically from that transfer?
Yeah, and so the operating company family offices I think broadly have more family involvement, and that transition's been already mapped out. On the investment management, asset management families, we're seeing that. So the majority of our families are first generation, as you said. They have independent family offices. The principals are moving into their kind of late 60s, early 70s, still incredibly active, but they're beginning to bring in the second generation. And there's also a difference. I think there's some families that say, listen, the investment management firm is designed to invest on behalf of the family to protect the wealth and provide opportunity for all family members. And we're going to do that almost exclusively externally of family members. So it's just basically an operating company. Or the other side, which is this is a family-focused investment management firm, and multiple generations are going to be the stewards of that capital. So we're beginning to see G2 come in. G2 is incredibly well-educated, has usually had some form of outside expertise at a investment banking program, private equity fund, or venture capital fund, et cetera. So they're institutional quality. obviously there's a great level of alignment. They're doing a very good job and are learning from some of the best operators and investors out there. I think the other thing that we'll see, so I'm not sure, is as G1 takes a step away and G2 has more ultimate authority, they've been raised in entrepreneurial families. They've been at the dinner table since day one. Do they start to look to take a portion of that wealth and make their own mark and become more entrepreneurial down the road? That is to be determined. I don't know the outcome, but I wouldn't be surprised if that was the outcome.
Got it. That's interesting. Well, one of the things that we've heard from many second generation groups is a push towards philanthropy. I think there are a lot of next gen who feel the incredible responsibility that comes with great wealth to try and do something positive with it. And we're seeing some philanthropic movements there. And that leads me then to a question about you personally. What are some of the causes that you and your family have found important?
So my wife and I and our children, donate the majority of our time or spend the majority of our time on efforts related to our church and our kids' school, which is one and the same. So that's been very enjoyable to give back to the community and do it with our kids, who are young. They're 8, 10, and 12. And so that's been an exciting process. I think from a giving standpoint, I am personally much more focused on childhood hunger in America. It's one of the things that I don't understand. We live in one of the wealthiest countries in the world. We waste roughly 40% of our fruits, vegetables, and proteins. And I would wager within, you pick it 5 to 10 miles of your house and my house, we have kids who are going hungry. That doesn't make any sense to me whatsoever.
It's very hard to disagree with feeding hungry children. Kudos to you and your family for doing that. Sean, it's time to go to our closing questions. So I'm gonna go with the standard ones. Tell us a book that most influenced your thinking or your personal development.
Yeah, there's actually a book that was given to me by my mom in the early 2000s, and you may have read it. It's Setting the Table with Danny Meyer.
No, I have great respect for Danny Meyer. I've eaten at his restaurants, but I know I have not yet read the book. Tell us about it.
Yeah, I'll send a copy to you. So people who are listening who aren't familiar. So he's a restaurateur out of New York City. He started in the late 90s and I think had more of a success in the 2000s, but he created Union Square Cafe, 11 Madison, Tabla, a bunch of other institutions. He also created a Shake Shack, that obviously a large public trade company. So he wrote this book that's partially autobiographical, partially a business management book. And I personally love it because I'm very into food. I'm very into traveling for food and restaurants. So it was an easy piece. But the other thing that he talked about that really shaped some of my thought process was around customer service. And to your point earlier in our discussion, I can have the very, very best food and not have much culture, not have much involvement with my customers, and they're going to come eat with me maybe once a year. Or I can create a community, provide very good food, very good ingredients, but have these diners come in and be part of our culture, part of our ethos, and that can create a much better outcome. The other piece that he shares in this book, which I think is helpful, is you have multiple transactions with customers on a daily basis. They're going to happen either way. It's up to you to inform whether that will be a positive experience or a negative experience. And the more that you can align yourself with the customer and have them feel that you're on their side, it creates a better experience. And so I thought it was a great book to read. And
that's fantastic. Okay. What's the best advice that you've received from your parents or you give to your own kids?
The advice I give to my kids right now is to listen and get along, and they never get in trouble. But that's a bit more short term.
Hope that works out.
No, it's not, but we're trying. The advice that I learned from my grandparents and my parents is to embrace what I'll refer to as thoughtful risk, that you need to have some form of risk in your life. I think it helps with development, but it also, if you're going to really live the life that you want to live, you're going to have to take some chances. And those chances don't have to be a one-way street. You can take risk and have it not work and go back and rebuild and try again. And that's completely okay. The other piece that is very important, my wife and I come from a long line of very hardworking people, is that there's no barrier to entry to hard work. I'm plagiarizing a quote from Calvin Coolidge, but you'll have people who are smarter than you, that are better educated than you, that come from quote unquote better families from you. It's just have a bit of a leg up in life. And generally speaking, if you outwork those people, you'll have a better outcome. So those are the two things that we believe.
So in the Declaration of Independence, it talks about freedom for life, liberty, and the pursuit of happiness. Sean, what do you do in pursuit of happiness?
I am happiest when I'm outside, be it hunting or fishing or scuba diving or whatever that ends up being. That is balanced by really spending time with my family. That is one of the happiest things. And it's funny how it's evolved. And I don't know if you've experienced it. Your kids are a little older than mine. But it used to be events and vacations and things of that nature. And as I've gotten older, my happiest things are the most simple things around the house, be it playing a board game or watching a movie together or whatever. That ends up being very, very low barrier to entry things that are so much fun to do with the kids.
It's great. The simple things are often the good things in life. Sean, this has been a real pleasure, as it always is when we get together. I thank you for your partnership. I thank you for joining us today.
Thank you, Todd. Really, really appreciate it.
This podcast is provided for discussion and informational purposes only, for use by Declaration Partners, LP, together with its affiliates, referred to as Declaration. The information discussed in this podcast may change at any time without notice, and there is no duty by Declaration to update any person to whom this information is provided. This podcast does not constitute an offer to sell or the solicitation of an offer to purchase any investment product or any interest in the fund or any other investment vehicles or accounts managed or advised by Declaration, a Declaration investment product, in any jurisdiction to any person. Any such offer or solicitation for interest in any Declaration investment product will only be made pursuant to such Declaration investment product's definitive offering documents, which contain a description of the material terms, including risk factors, conflicts of interest, fees and charges, and regulatory and tax considerations relating to such Declaration investment product, and which should be reviewed carefully by potential investors prior to making an investment decision. This podcast does not constitute tax or legal advice. The listener is urged to consult a professional tax and/or legal advisors regarding the possible tax, legal, economic, regulatory, or other risks and consequences associated with any investment, and must be able to bear the risks involved. This podcast may contain certain forward-looking statements which constitute Declaration's views with respect to future events, which can be identified by the use of forward-looking terminology such as intend, seek, expect, target, projects, or endeavor. These statements are made based upon such views as they exist as of the date herein. There is no assurance that such views are correct or will prove, with the passage of time, to be correct. Actual events or results may differ materially from those contemplated by such forward-looking statements as a result of factors beyond Declaration's control, including, without limitation, any disruptions in global, regional, or local financial, credit, or real estate markets, acts of God, fire, hurricanes, tropical storms, floods, earthquakes, or other natural disasters, outbreaks of an infectious disease, pandemic, or any other serious public health concern, war, terrorism, labor strikes, electricity shortages, or other national or local emergencies, or any combination of the foregoing. David M. Rubenstein is an anchor investor in Declaration Partners Real Estate Fund II and is not an employee of Declaration. Neither the U.S. Securities and Exchange Commission nor the Securities Regulatory Authority of any state or other jurisdiction has passed upon the accuracy or adequacy of this podcast. No compensation has been awarded to any speaker for statements made that are either testimonials or endorsements. However, certain speakers may be current or former investors in certain Declaration investment products and may receive reduced fees, priority terms, priority access, co-investment rates, among other preferential treatment, which may pose a conflict of interest. Certain speakers may also be affiliates and/or service providers that receive compensation from Declaration for services provided in their service provider capacity, but have not been compensated specifically for any testimonials or endorsements made herein. All statements made on the podcast are the opinions and beliefs of the speaker and may not necessarily represent the opinions, beliefs, and position of Declaration. Consequently, from the foregoing, no reliance whatsoever should be placed on this podcast, and no decision including any investment decision should be made based on this podcast or on the information contained herein.